Welcome back to Golden Rule Radio, your weekly precious metals recap, and certainly we're going to be looking forward a little bit into the end of the year as well, and we're going to start this week with listener questions like we often do, and this comes from a T. Agler. The question is, who won lunch this week?
Well, I can tell you the American public didn't win lunch today, as they went ahead and raised interest rates, forcing the equities market down to the lowest price since November of last year. As far as our particular bet goes, that's the last time I'm going to be placing a bet on the U.S. dollar. Although I got to say you cheated, Tori, since about 89-90% of all people in America thought you would be right. I still hold that it was the wrong decision.
Well, let me tell you, when you and Robert are in the room, from a technical standpoint, I'm easily the third smartest guy in the room. When it's just me and you, like it is again today, and Robert's gone, I'm the second smartest guy in the room. So I'm definitely not going to gloat, and I'll just chalk that up to one of the rare instances that we put anything on any sort of a line or wager anything in here, because the precious metals markets, as we know, react, right? And they react to monetary policy and decision makers from a human standpoint. And so we can sit there and try to act as informed, as intelligent as we can. But you may say that 89-90% of the public felt like it was going to be a rate hike. To me, really, it started looking more like 50-50 as we got closer to today.
Sure, and that brought into the question of what was the market doing to price that action in leading into it. I mean, we had all the metals up, we had the dollar down, and we had the equities market bouncing slightly. So as of this morning, I actually had the assumption that I might end up being correct, although over the last couple days, the market action was the obvious, factoring in the assumption of a rate hike, and that's what ended up happening. So it doesn't surprise me at all as we got closer to it. Maybe that's just exposing my personal assumption, if not prejudice, towards the expectation of government intervention, because I know Trump, as well as Washington, would love to end the year out on a high note. But as of this point, we're down 6.5% of the year, down 14% on the Dow from that high back in October.
14%. And in the S&P is on track to set its worst December since 1931. So it's not just the Dow, it's all the indexes, right?
Sure. So I wouldn't want to be the guy that placed a massive buy order on October 3rd this year, but somebody had to.
Right. And gold is doing exactly what it should. And I was actually encouraged by the price action. I think that, we did see a little rally this morning. We're off about $7 from that peak in gold. But keep in mind that we're over 1240. And I've been calling, this is where I have been wrong, I've been assuming that we would actually see a little bit of a downturn towards the end of December. And yes, there's still a week to go, and we may still yet see that. But the fact that gold did drop today on what should be perceived as strong dollar policy, what's been the anomaly is the fact that we've raised rates 7 previous times, and oftentimes you've seen gold pop up and the dollar turn down. That just goes against all, long-term economic education. And the fact of the matter is this is strong dollar. So the dollar did pop, gold came back down a little bit, and the equities market said they don't like it.
Sure, and even CNN and some others brought Alan Greenspan out of his money cave. But he did come out, going, he's the quintessential Darth Vader, right? I mean, the guy had a foreword in Ayn Rand's book talking about the dangers of hyperinflation, then spent his entire career inflating the currency, and now he's obviously gone back to the other side talking about the dangers of hyperinflation. The quintessential power corrupts, absolute power corrupts, absolutely. But the guy does know what he's talking about. I mean, he's had plenty of years and decades and millennia to perfect his education. So saw him on TV following the rate hike today, as well as his report on CNN yesterday, expecting troubled waters ahead.
Well, and I think that that's rightfully so. I'll tell you what I do think the Fed will do. Okay, they did come out today. They raised the rates a quarter point. They did say that they expect there to be 2 more in 2019 with no prediction of timing, right? I don't personally believe that it'll happen in the first quarter because the markets are seeing this downward pressure, and it's not the Fed's job to control the equities markets, right? They have an employment and inflation mandate. They do not have a stock market mandate, much to the chagrin of our president.
So Greenspan came out, said it would be very surprising to see it sort of stabilize here and then take off. He did add, of course, the markets could still go up further, but warned investors that the correction will be painful at the end of the run for cover. So could be seeing a similar play out to the 08-09 crash, where we see this massive leveraged run up to where we just run out of steam. Obviously, coupled with the increased interest rates at this point, is going to make for a very expensive market to keep propped up going forward. So we know what can follow if the Federal Reserve is willing to get involved and flood a bunch of money into the market. How many times do they get to do that?
And folks, this is why you own gold. This is why gold is a hedge. And Miles alluded to the fact that we're off, 13, 14% from peak to trough in the Dow. And during that same period of time, gold's up $70. Okay, we saw a little bit of a reversal today in gold, about a $12 reversal from peak to trough intraday. And then we saw the same thing happen in the Dow. How much? 600 points. Okay, so the fact that you're owning gold here, to me, again, it's been very bullish, very strong. We're not seeing that in the white metals. It's acting much like oil. Oil continues to decline. It continues its bearish trend, and right now it's at $48 a barrel, but it was below 46. And so we're seeing some broad-based commodity pressure with this dollar strength. But keep in mind, gold is its own entity. It's acting like a money metal right now. And that's exactly why you own it in your portfolio.
Well, and that's a really good point, Tori. I mean, looking at gold, looking at the other metals, silver, platinum, palladium, even looking at the dollar, show me where the Fed announcement happened today. Just looking at those charts, if I didn't know that an interest rate occurred on today's date, I wouldn't be able to pick that out on a chart. I mean, nothing happened today outside of the equities market. The equities market is the only thing that moved in lieu of the interest rate rise.
So let's not move any further without going back and doing the technical chart analysis of the precious metals today.
Yeah, Tori, gold's stair step over the last, really since September. So last quarter here has been pretty defined. I mean, we came right up to that 382 fib prior to November, corrected back down. We've come just shy of the 50% line now. And I think about to take another step up towards it before we have another correction back down. Then it's the 618. Then we start pushing for those highs again back up above 1300. So you can see the price action today, obviously somewhat having to do with the interest rate rise, but things always line up. I mean, we're looking at a price action reversal going back to July this year. It was the first time we were pushing down to those old November 2017 lows. Again, to me, this isn't a news-driven market. This is just a technically driven market. You're seeing traders switch positions. We've been watching the COT report for months. So this is just ordinary trading, certainly since about July, August of this year.
Yeah, and that does make a lot of sense because geopolitically, it's sort of the same old news. We do have a few things going on. Again, gold reacts to geopolitics just like it does monetary or economic policy. And geopolitics often are the result of human decisions as well. And we are threatening to pull out of Syria. That's pacifying. We are saying that we're going to come out now as an administration and offer up a peace accord with the Palestinians and Israel, and that's pacifying. And so we'll see if Trump really means it. But, within the last 6 months, it has actually shocked me that we don't see more volatility in response to gold. But you're right. This is more predictable ins and outs in the technical trading in gold.
Yes, exactly. The levels are apparent. And we're moving between levels in a very systematic fashion. Like you said, in spite of Syria, in spite of Theresa May, in spite of issues in France, in spite of tariffs between us and China, you're seeing a really predictable, at least American market as an outcry of that. I think that's why we've both been calling, even though in the long run we think the dollar's going down, we think it's going to continue up for a short period of time because of some of those other issues. So as we see these things play out over what I think is a pretty short timeline, maybe the next 6 months, we're going to see some pretty dramatic changes in certainly the equities market, as well as the precious metals market, as I think we will test those previous highs and things will start to get interesting.
So from the silver standpoint, we're in that same narrow channel, and we have been really since, end of August, early September. And as you'll see in the chart here, we continue to test that previous high, and we did that again today before we pulled back a little bit around the 1480 mark. But do we expect it to come back down? Tough to tell. Again, this is a quiet time of year. I'll tell you what will ultimately drive the white metals is if the Federal Reserve does begin to ease its tightening. Okay, can I use that in one phrase? If they go back to more of a quantitative easing, then you'll see inflation concerns pick back up. They can leave interest rates alone and just play with their balance sheet a little bit in their quantitative tightening versus easing. But the white metals are acting like many commodities. Again, the only one that's been an anomaly has been palladium. So why don't you talk a little bit about palladium this week?
Yeah, palladium keeps compressing up around that highest price ever point that we've been at now forever. But I do, whenever I see compression at the top end of a level, you expect some type of reversal there. And there's a number of points substantially lower than here that palladium could correct to and still arguably be in a bull market. I mean, we have hundreds of dollars of down movement just because the up movement has been so aggressive. So we're still looking for a topping out in palladium. Could have seen it now, could continue up, I'm not sure. But I think that's when you fall back to the ratios and you start looking at the price averages between the different metals. Palladium versus platinum obviously is a big one, even palladium versus silver, palladium versus gold, and how those relate to each other. So continues to push us towards platinum and a platinum recommendation on the metals as platinum is sitting at some of its lowest prices in a number of years.
I'm really glad you brought up the ratios because I want to do a quick summary. Okay, the ratios that we follow ratios far more closely than we do spot price, believe it or not. Okay. And there is so much potential energy in the ratios right now in the precious metals markets. We are at extremes that we rarely, if ever, have seen, right? So the gold-silver ratio over 84 to 1. The platinum to palladium ratio, 0.62 to 1, meaning, obviously it's almost half of what palladium costs. Platinum to gold, 0.63, again, almost half of what gold costs.
And lowest in history.
We've seen that. Yeah, lowest in history. And we've seen that 2, 3, 4, even 5 times the price of palladium and double the price of gold. And so you can see the potential there for huge swings and ounce gains in the ratio trade. But you also have the Dow gold ratio. What you're seeing is weakness in the Dow, in the equities markets, and a little bit of strength in gold. And it's doing just what it should. Okay, and we've come off of the mid-20s down to now below 20 to 1 on the Dow gold ratio. So continue to watch that. And when that gets down into the single digits is when you'll know that it's time to move from gold back into the equities.
Yeah, Tori, and the reason that we stress these ratios so much is not because we think that they're set in law or anything, but because we want our listeners and our clients to understand the cyclical nature of how markets relate to each other, because that's where you, over the period of a lifetime, end up making substantial moves that drastically increase your net worth.
Yeah, we have to follow the macro trends. And I'm going to point out one more macro trend. All right, nothing's going to change in the U.S. dollar until the European Central Bank or the Bank of Japan start making moves. And they start changing their policies that ends up eventually strengthening their currency. Okay, then it'll be the dollar's turn. Until then, we continue to make the same mistakes over and over again. We're edging right up against $22 trillion in terms of our federal debt. Our national debt is inches from $22 trillion. So clearly there's no lessons being learned here because they figure as long as inflation isn't ruling the day, they can keep on going. And at some point that catches up to us. And at some point, if you don't have your gold by then, it will be too late. This isn't about a return on capital. This is about a return of capital. And that's why we stress gold in your precious metals portfolio.
So, Tori, as we wrap up this show, I want to touch again on one more of our listener questions from last week. Where do you go to buy your precious metals? It's an interesting question because it's something that we've been doing since 1972. We are one of the oldest precious metals firms in the U.S. We do try to not turn this show into just a walking weekly advertisement, but more importantly, an informational conversation with our clients and listeners, but with the hope of maybe meeting and getting to know some new potential clients down the road. So as a result, we'd certainly love to have a conversation with you, even if you're already a metals investor and would just like to sit down and maybe talk through your strategies, including your exit strategies, swap strategies going forward, and help you allocate that appropriately to earn the best possible returns in your tangible assets.
Well, thanks again for joining us this week. Make sure to follow us on Twitter at ICA Gold and subscribe to this podcast by clicking the subscribe button below this video. If you give us a call at 800-525-9556, we can do just what Miles was saying and walk through your own portfolio with you as well.
And you can swing by Facebook at McAlvany Financial. Thanks for listening, and have a great week.
And a very Merry Christmas to you and yours.